What is going on, you guys, and welcome back to another video here on the channel. My name is Brandon, and in today's quick video, I actually just thought of this video topic this morning as I was getting ready, and I just thought, hey, come into the office and film a quick video, because if you've been following the channel, I did a video on my personal biggest investing mistakes, and there was a really good response on that video, and people really do love to learn from others' mistakes. I think that's really one of the best ways that we can kind of grow in this industry. And now that I've been doing YouTube for coming up on a couple years, like it's going to be close to 2 years in just a couple months, I've had a lot of time to observe what the viewers at home, how you react, and how just the overall sentiment and the trends and things you guys do. And in today's video, I just wanted to highlight a couple, actually I have 3 points here, 3 mistakes that I found you guys at home, the viewers, tend to make. And I don't make this video to say you suck and you are a bad investor. Not at all. Actually, it's the opposite, because as part of becoming a good investor, as part of learning and advancing in your personal career as an investor, you have to make mistakes. And a good investor, at least in my opinion, is somebody that can assess those mistakes and not only recognize them and assess them, but learn from them and see where they can evolve from that. So let's get on into the video. If you do enjoy these, by the way, feel free to give a thumbs up. But the first mistake that I find many investors make, and it's a pretty big one, is worrying about the exact entry price on a stock that they're looking to buy. And I really do get a ton of questions. Even on the last 3 stocks to buy video that I did for October, I believe I got 2 or 3 comments there saying, well, what is the exact entry price that I should be buying the stock at? Or what price should I be pulling the trigger on this stock? And I completely agree with the idea of having a level that you want to get in at and researching and understanding a business to know whether it's at a value you want to pay or not. But it goes a little bit overboard when investors are saying, I could have bought in at 187, like, I don't know. Okay, let me think of an example. I remember people talking about Apple stock, for example, and when Apple was dropping a little while back because they stopped releasing their phone reports, the volume of iPhone sales, I think we can all recall that. I came across many viewers and many investors who were saying things like, oh man, I bought Apple today at 165, or I bought Apple yesterday or 2 days ago at 165, and now it's trading at 161, or it's down 2 or 4% since I purchased the stock. And they're so focused on these very, very minimal movements, essentially trying to pick out a bottom, trying to find that lowest price that they're going to get when it comes to buying a stock. And as awesome as that is, that's crazy to think that you're ever going to nail that exact bottom price. You're not going to hit the bottom. It's a simple fact is that. And if you are an investor, which is really who we do try to focus here on the channel, we're talking here long-term investors. If you look out 15 to 20 years on a company like Apple, and we don't know how Apple's going to do, but let's assume the company continues to do well, it's not going to matter whether you got in at 165 or 163 or 155. It's really not going to make a difference. I can almost guarantee you of that when you look 10, 15, 20 years out, which is in many cases the holding periods that I personally aim for on the channel. This does become a little more sensitive of a topic when you're a trader and you're worried about your exact position. But the first mistake I think people need to understand, or that they make and they need to understand, is you're not a trader. You're an investor. And when determining your exact entry prices, I think that you can take a step back, not get so focused on that exact price, and just kind of think of a stock as fairly valued, undervalued, or overvalued. Because like I said, you're never going to hit the bottom. And if I were to just throw up a couple examples on the screen, I don't even have any off the top of my head here, but even if you didn't hit the exact bottom on a stock price like this, you would be relatively happy to get in anywhere in these levels. Is that not correct? Now, if we have a stock that's dropping today, I think of a company like New Flyer, which is a stock that I've personally added to my portfolio. I've got high hopes for that company going forward. I am not concerned with the exact price that I buy in at. I don't care whether I buy in at 28 or 31 or 26. If I fast forward 10 years out, it's not going to matter the exact price that I got at. And that's something that I do think a lot of you guys at home can benefit from, is to just take a step back and not worry about that exact price. But moving on to the second mistake that I see a lot of people make, and this is actually a really good one here. I have an example for our Canadian viewers, and that is letting the tax tail wag the dog. And that's actually one of my favorite quotes. I don't know why I find it funny to say sometimes, but what that means, and the name kind of implies itself, but it is an investor that is worrying so much about the tax consequences of a specific investment that they neglect to worry about the investment itself. And in almost all cases, your main priority should be the investment first, and then you worry about things like tax. That is almost a secondary thing to worry about. And where I've noticed a lot of mistakes, or I shouldn't say mistakes, but this is just my opinion here, where I've noticed a lot of viewers at home, what they do in particular is with TFSAs. And a lot of you guys do know by now that dividends in your TFSA, if they are a US dividend, they are subject to a 15% withholding tax. It's a question that we get all the time here. And some of you know that, some of you don't. But essentially, US dividends are taxed differently than Canadian dividends when held in a TFSA. Now, I've come across many investors that say, well, now I don't ever want to hold a US stock in my TFSA. I don't want to pay a 15% withholding tax on my dividends there, so I'm just going to build a portfolio up of Canadian stocks. Now, that to me is letting the tax tail wag the dog, because again, our main priority should be on the investments. And if you can find a US investment that is far superior than a Canadian investment, but just because you're going to be paying a little bit of tax here on the dividend, you're going to neglect that because of that small tax, to me, what that is that's looking at things with a very, very narrow scope. And what you need to do is you need to take a step back and look at it from a holistic view. Because if this investment, despite the 15% tax, is going to provide you with a much better return, then that is the right investment for you. And that's why in my TFSA, in my portfolio in general, I do have a fair amount of US stocks, because I believe that the US market is it's the strongest market out there. It's one of the best markets to have my money invested in. And in all honesty, I probably wouldn't want my portfolio solely invested in Canada, even though you're getting these tax benefits or they're taxed more favorably. I'm more concerned about making money in my portfolio, and if there's a better opportunity here with US stocks, for this given example, that's where I should put my money. So that should be the main priority. So the second quick mistake there that I've noticed is investors letting the tax tail wag the dog. Now, the third and final tip here, it's very simply seeing investors chasing trends, chasing hot sectors. And, I feel like I mentioned this one all the time on the channel, but it never stops. And there's a good reason why it doesn't stop. It kind of boils down to the psychology of an investor and the psychology and the way our brains work as human beings. I'm not trying to get too scientific here, but naturally we are drawn to the hot sector at the moment, whether it be an IPO, whether it be marijuana stocks, whether it be cryptocurrency back in the day. And that is completely natural, because that's where the gains are. The reason that you're hearing about them through your workplace, the reason that you're hearing about them online and through news articles, and in many cases here on YouTube, you see a bunch of videos and channels covering them, is because they are making people money. They're making people some very, very quick gains. And in all honesty, by the time you hear about that trend, by the time you think, oh, wow, I need to get into marijuana stocks, or I need to get into Beyond Meat, whatever the case is, Uber, this and that, in many cases, you are going to find yourself getting burned by chasing or following that hype or chasing the gains. Because you know, if there's one thing that I truly do believe on this channel, and it's something that I personally do my very best, and don't get me wrong, it's very hard. It's very tempting sometimes to chase these hot performers or these hot sectors. But if there's one thing that I believe in, it's that following the hot sectors will ultimately get you burned, and taking your money to a place that's out of favor and boring often will reward you with some slow and steady gains. And you know, it's very, very tempting again, because when you do jump into a hot sector, take the marijuana sector, take an IPO, you can very likely make some money over the short term. If something is just trending up and it's gaining multiple percentage points a day and it's just really, really pushing up, and you know, if you jump into the stock, there's nothing to say that you won't make money for the next week, for the next couple weeks. Hey, in some cases, 3-6 months, you can continue to make gains. And that actually just kind of amplifies the whole issue of it. It just amplifies things, and people end up buying more. And then guess what? The stock reverses, or the bubble pops, and things go the opposite direction. And investors that were chasing these gains, investors that were super interested in these stocks that have been doing very well and are very hyped and hot, they often end up losing a lot of money. And the tough thing is, at the time when someone tells you, you know, don't do that, you look crazy for saying that, because again, you can definitely make money over the short term. But you know, if you are able to look 6 months out, a year out, in many cases, those trends reverse. And whenever I see a hot sector, something that's hyped, I'm happy to watch it, but I don't ever really want to deploy my money in that sector unless I'm really trying to get in and out fast. But one of the mistakes that I commonly see people make is saying, well, I'm a long-term investor, and you know, I see huge potential for this or that, but because it's so hyped, it totally skews the actual availability to invest in the stock properly, invest in the business properly. And in many cases, you just find yourself buying in near the peaks. You find yourself buying in so high, and it's just a mistake that I see so many investors do. But I will just go ahead and wrap up the quick video there. This one was kind of just off the top of my head, not too much planning there, but I did think that these are 3 mistakes that I very commonly see. And again, if you can look at yourself and say, hey, that kind of sounds like me, that's not a problem. Just address it and see where you can build going forward from that, because that's really what it's all about at the end of the day. Just continue learning, continue getting better, learning from your previous mistakes. And that goes for myself, that goes for anybody out there. We just continue to learn and learn and learn. If you guys enjoyed the quick video, feel free to give it a thumbs up and subscribe for more content. We post a video here every week. And if you want to check out our Investing Academy, it's that first link down in the description below. Go check out the training. We are taking on new students at the moment, so feel free to check that out. And I hope you guys enjoyed the I keep saying quick video. Hope you guys enjoyed the video. I will see you in the next video.